Hi everyone, welcome back. I am here with Lars, who you met in the previous video. I'm actually getting the opportunity to ask Lars some personal questions about investing. And I don't know whether he'll answer all of them, but I'm going to give it a good shot. First of all, I want to ask you, what is your opinion or thoughts on building long-term diversified passive income streams?
Well, I think there are a couple of obvious answers. One is that you obviously need to think a lot about your risk when you put money aside. How would you feel about the markets declining a lot? It's actually interesting when you think about that. So sometimes when markets decline a lot, it's a great opportunity for you to think, did I get it right to start with? So let's say you put half your money in equities and the other half in this kind of riskless asset, and markets go down 20%. Do you feel, well, this is great because I can now add at a lower value?
See, I look at that as a stock take clearance sale. I can buy more of the same stock at a discounted price.
So that probably suggests that you were too low risk to start with, right? Yes. Because how would you know? You don't know ahead of time if markets are going to go up or down. Or if you do know, then do let me know, and I can introduce you to some interesting people. But it's very hard to know. Assume you don't know. And let's now take, if you go back 10 years and you say the peak of the market, whenever it was in 2007, and there were a lot of people right then, really smart, well-educated people saying it's going to go up forever. Right? Now you go a year and a half later and market's down 50%. And you say, well, what a great opportunity. Right? Now, actually a lot of people then said, well, now you need to sell. But this whole idea that just because markets went down, that you're better able to pick markets, both in terms of timing or individual securities, is a complete fallacy.
Okay.
There is no evidence whatsoever that you're able to do that, or if some other event happens. Like a typical thing was Donald Trump gets elected, or there's Brexit here in the UK.
Something happens.
Everyone, maybe it's the football
everything.
now, I don't know. But just because something happened, don't get, not fooled, but don't start thinking that as a result of that, I can pick the markets.
So don't try and time the market.
Don't try to time the market.
Buy an index fund or index ETF or even a stock and try and jump in and out to make a quick profit.
Absolutely. I will say a couple of things about that. One is, just because the market changed doesn't mean that nothing changed for you. There's some interesting numbers around the risk of the market, and we can actually say something about the risk of the market. So we all know equity markets are risky, but how risky? Right? So if you go at the peak of the market in 2007, actually much like today, the forward expected risk of the market, I can walk you through how that's measured, but it's a market-based thing, so it is a real number, was very low. So in 2007, there was not much expectation of risk.
Okay.
You fast forward to March 09 or whatever the peak or the worst point was, and the risk had skyrocketed. And clearly it's because people were afraid. Lots of bad things have happened, so the back of people's minds, thinking more bad things will happen, and
letting
so forth.
people's emotions just driving investment decisions.
Yeah, or you had lost half. How do you know you're not going to lose the other half? That kind of stuff. The world is collapsing. Every article you read now is about
doom and gloom.
But if you take a step away from that and think about, now risk has gone up. Future expected risk has gone up. It's not unreasonable to say, well, with that you should expect higher returns. And there's actually academic evidence to suggest that at times of higher expected market risk is after the fact higher returns, which makes sense because you want to be paid more to take more risk. The old risk return. So now it's higher risk in the market, you should expect more returns.
Okay.
But it's not free,
okay,
right? Because risk means that it can also go horribly against you.
Exactly.
So one of the worst things I think you can do as a retail investor, also as an institutional investor, is to constantly try to game things, right? Because one thing that is dead certain is you will constantly pay fees, not just your brokerage fees, but potentially taxes. You will pay bid offer spreads. You will pay market impact things. You will probably not be able to net effectively. And so if you just keep doing that, you will lose.
And you miss those really important dividends.
Yeah, well, so dividends are, my view on dividends is it's a great source of cash flow, right, and can be. It obviously depends on tax circumstances, which varies from country to country. In some countries, you don't actually want to receive dividends.
Yes.
Others, you definitely do. I'd also say always take advantage of whatever tax incentive the government has. Here in the UK, there's a certain amount you can invest tax-free every year because they encourage savings. I don't know if you have something
We
similar.
have something similar with imputation credits.
Okay, so use those. And I think generally speaking, if you do that, and I know it sounds boring, which is why no one ever does more than one interview with me, right? Maybe it's me, but it's because I'm telling you, you can't beat the markets. Go buy a boring product. Don't ever do anything else. Don't wiggle around with it.
Yeah.
Think
buy
about
and
your
hold.
risk. Buy and hold.
And add to it when you can.
Add when you can, absolutely. But that almost gets into sort of personal budget stuff, right? If you can put money aside, absolutely do that.
Well, we're going to be talking about adding money to investment portfolios in a second in another video. But, okay, do you recommend, if possible, people reinvest their dividends?
Well, absolutely. I mean, I think, but let's not forget, if you ever need the money,
of course, yeah.
like let's say there's a life-changing event, or your children go to university or something, and you need the money, you're actually investing in one of the most liquid financial products.
And this is the thing, people don't, like, people love, a lot of Australians have a love affair with investment property, and I will completely disclose that I own investment properties as well, but my passion is actually shares because they're so much easier to manage, less stress, less more profitable owning shares, but also the liquidity. I can't sell the front door if I need $10,000.
So if I can just like unfriend half your viewers, that makes no sense.
Yeah,
right? And I'll tell you why. So let's say from vast majority of people that own a flat or their house, it's by far their largest investment. Right? And I can see the emotional aspect of that, and I accept that. I own property myself. But to take your investment portfolio and invest in more property, it does a couple of things. One is it adds to your local exposure, right? So you live in Sydney. So let's say you own your apartment and you have a bit of money, you buy another apartment down the street because you think it's such great value. You've just taken liquid cash and made it illiquid. You've probably geared that investment because you got a mortgage, perhaps. You're really all in with Sydney. Sydney better be the place of the future. Not that I have any reason to know that it is or is not, right? But don't do that. Right? Unless, and there's like all sorts of historic evidence that does residential or commercial property do better than the stock markets. They sort of depends. Like if you had picked London 15 years ago, then you would have made a lot of money. If you had picked Miami, you would have been bankrupt. Yeah,
there are a lot of variables. And
you
to
just
get
don't
it right,
know ahead of time.
Yeah.
So don't go illiquid, and don't add to your local concentration.
Okay.
And it's generally half the people in the US that went bust in connection with the credit crunch had done that.
Okay. My next question is, what is the best investment advice you've ever received?
So I was very lucky to so I went to business school with some fantastic professors. And actually it was interesting because one of my advisors is a gentleman named Robert Merton, who has a Nobel Prize, not only that, but he soon after was a partner in Long-Term Capital, which was one of the largest ever financial crashes. And it was so interesting to have that kind of a person, who on the one hand has also the credential, but also lost billions of dollars, or was part of losing billions of dollars, and have him question the idea that all of these self-important Harvard Business School people can't beat the markets. So if you can sort of put us in the situation where we're sitting there thinking, here's someone with an IQ of I don't know what, telling us that it is, just accept that it's possible. And then take it a step further. That if you accept that it's possible for you, then there are a lot of people where it's certainly likely. And they took me down to this path of saying, well, I might run a hedge fund, and I might think that I can beat the markets, but that doesn't mean that it's for everyone. And the people that invest in money with me have to answer that question themselves. Do I think I can predict that Lars will beat the market? So no, it's a convoluted answer. And then, I mean, I was lucky. I was brought up, I think, like yourself, that lots of jobs, always put money aside. I'm one of those nerds. I still am today. I put money aside and invest it.
I believe it's also quite ingrained in the Scandinavian culture. Like you're very wise and sensible. Typically, was a very sweeping generalisation. I read that the economic position of Scandinavian countries is quite
Is that
a
right?
lot healthier than
government
typically,
fund.
you know, UK, Europe,
Yeah.
Australia, and the US. You know, it's different way of spending, generally a more conservative approach
To
when it comes to spending and cash flow.
Okay. Well, I generally say that I think that when you look at the extension of credit to individuals, it's the devil's work. Like you have these credit cards, obviously, but payday loans, and you have things like that that will be very likely to ruin your life or your financial life.
Okay.
And I mean even it's obviously different if you have assets. But when we talk about invest in the stock market, this is one thing I want to make very clear. If you have credit card loans, pay those off
Before you start getting into
before you
investing.
start in investing, because if you look at, like, who knows what the stock market will do, but if you look historically, the stock market across all the collapses and all the rises, and I'm happy to talk to you here of how I get to these numbers, but it's generally accepted that it's roughly 4 to 5% above inflation a year.
Okay.
So that's roughly what, given average risk and who knows what's going to happen, I think that's sort of a number you can reasonably expect over the next 30 years. And in any one year, anything can happen.
Okay.
Now, if you have credit card debt, it's going to cost you a lot more than that, right? So don't invest in the market and have credit card debt.
Yeah, it doesn't make sense.
Doesn't make any
Going
sense.
backwards.
It's a certain way to lose money.
Okay.
And generally, even if you have a car loan, it's often above that, including all the penalties and so forth. Right? So pay those off, absolutely.
All right, and my final question for you is, for someone who's like, you know, young, just finished university, or about to start their first full-time job, really excited and actually want to make a difference in their financial future, what is the best bit of advice you can give to that young person who's just about to start their working career and they want to be wise and sensible with money?
So I think, look, I'm just going to go against myself a little bit. I think just jump right in. You save a bit of money, put some money aside, try to not touch it. Get in the habit that the stuff that's in your investment account at whatever custodian you have, is sort of, that's your pot.
Yeah.
And try to not ever touch that. And if you can add to that whenever you can, and don't blow it up to go on an expensive holiday, but if you can get into this lifetime of, you know, putting money aside, being sensible about what you do with it.
Healthy financial habits.
Absolutely. It's just, you will just, there's all sorts of statistical evidence that I won't bore you with, that the benefits of that go far beyond finance. Right? It makes you deal with adversity more. It actually makes you healthier.
Yeah.
It's all of these things.
Happier.
So if you can, and just this idea that you go into a stressful period in life, whether it's divorce or it's medical emergencies or anything like that, knowing that, well, I sort of got my finance a little bit under control. I can afford to smash my car. Like there are people, you know, that just, if certain things happen, they'd be toast.
Exactly.
Right? And it's just not a nice way to live.
No, it's
So-
a very toxic way, I say.
It's actually interesting. I do some work in the developing world, and if you look at the poorest people in the world, generally the thing that characterizes that is not so much this image that they don't know where the next meal is coming from. Very often extreme poverty comes from one, not being able to afford one adverse condition. Your moped breaking down, your roof leaking, something completely unexpected. And by having a healthy financial, I'd say almost attitude to life, you can sort of mitigate that.
I recommend the way people structure their money is they have their like everyday spending money. They then have what I call a life account, and that's for the quarterly, biannual, and annual expenses. But in that account is a buffer for things that happen in life that just come out of the blue, so that if that suddenly something happens, it's okay. You can get back on your feet again very quickly. It doesn't weigh you down emotionally or financially, and then you can keep going. And then the third account is your saving to invest account. So every time you have money in that, say $1,000, you've got that. You can then shift it into, you know, buying an index mutual fund, managed fund, or ETF.
Yeah, absolutely right. I think it's.
Okay, so you know you're getting good advice from my channel.
Look, I think they're getting good advice from you. It's really true. I think it. I mean, even think you're in a. I mean, I know lots of people that are in really crappy jobs because they can't afford not to be.
Yeah, and that's so sad.
And it's just like, because they need that paycheck, right? And God forbid their boss stops liking them.
Yeah.
Because they can't even start looking for a job because suppose the boss finds out and fires them.
Yeah, yeah.
And
so
it's just
true.
this whole idea of having, like, almost think of it as surplus or the ability to withstand adversity is
Freedom.
critical. Yeah.
Yeah. Well, look, follow Lars' advice. And make sure you'll never regret following this advice. You'll look back and think this was the best 5-10 minutes investment into your own time. As I said in the other video, I will link in the video description box Lars' YouTube channel as well as Lars' books, and obviously all I'll do a create a little mini playlist on my channel so you can see everything about Lars. So if you haven't already subscribed, please make sure you do.